regarding the task that you booked last week.
Oh, the task is all this well, boss.
Serious lah. So it's okay. I trust you all, but I know you guys doing well, and just keep update me if any progress.
No worry, boss. No worry.
Alright.
Thank you. Let send you the file.
Alright.
Boss.
What if I call an urgent meeting right now?
Guys, bad news, guys. Boss said, he said, meeting right now.
Alah, relax ah. Apa kecoh-kecohin? Lebah apa kau?
Serious?
Hi everyone, let's start our meeting now. And first, I want to hear about the success company first.
Okay boss, I will tell you the story of Bank America. So during 2017, everyone know about the mortgage crisis. So they're having subprime mortgage crisis because borrower failed to pay their mortgage and causing credit risk and also mortgage related asset. And then what's make them almost become fail is about acquisition of countrywide and also acquisition of Merrill Lynch. So they thought they will make the company bigger, more asset, more investment, but then they still facing mortgage issue, credit increase, and also facing some legal action. And then they need to counter back their problem. So US Treasury provide around 45 billion in program that called Troubled Asset Relief Program, which is TARP, in 2009. And also they have also initiative which is called Project New BAC in 2011 to reduce cost, simplify operation, and also improve the efficiency. And then during 2013 until 2014 they become to recover, but then they need to face lawsuit with amount 16 billion USD. But then they settled the lawsuit, and after that Bank of America begin to recover. Next, for historical data of Bank of America, so in 2007 everything is normal. Net income, total asset, and share price is at normal standard price. But then in 2008 until 2014 they begin to decrease, but only total asset is at high amount during 2010 and also 2009 because That's when they acquired Merrill Lynch and Countrywide. And then during 2015 and 2016, they are recovering. So their net income, total asset and share price become normal back again. So next I will pass to HANIS.
Okay guys, udah siap belum? Let's go. First of all, Bank of America's problem actually started with a few risky decisions. At first, they acquired the Countrywide Financial. I think it sounds great, right? But actually, the Countrywide was actually heavily involved in risky mortgage lending. So when borrowers stopped paying their loans, Bank of America basically inherited the problems. And for the next issue is the bank had invested heavily in mortgage-related assets. So when the housing market crashed, the value of those assets dropped too. And somehow, even with all these problems, they even decided to acquire Merrill Lynch in the middle of the financial crisis.
For what?
Hiya, 我不知道啊。Anyway, because all of these decisions, Bank of America faced credit risk, market risk, and also liquidity risk. But luckily, they eventually got their act together by tightening lending standards, reducing their risky exposures, and also improving their liquidity management.
So, do they learn from their mistake?
Yeah, pretty much like that lah. They also improved governance, strengthened their risk oversight, and became more careful when making major business decisions.
And the consequences?
Well, shareholders lost money, confidence in the financial market dropped, and the entire banking industry ended up facing stricter regulations. In short, if your lifestyle is just so gayat and you have more than enough money, just go buy some banana pudding matcha or any Dubai chewy cookies, guys. Just don't go around and buy more problems. That's all. Let's move on to the next person.
Oh, that's why they're success. So now I want to hear about the failed company. SYAKIR and AFLAH, why you guys choose Washington Mutual as a failed company?
Fusion. So, let me tell you the tale of the bank which has failed in the America, Washington Mutual. So, it started in the 1899 where Washington Mutual have survived the Great Depression, and the first loan they made is at bad. So after that, in the 1917, they eventually become the first mutual saving bank of the Mississippi River. So they have survived the Great Depression and they gain trust from the people there. So, however, in 2008, the regulator declared Washington Mutual is unsafe and financial condition is really bad. So, JP Morgan acquired the Washington Mutual for around $1.9 billion, which made them the biggest bank failure in history. So let's check it out about the root cause for the Washington Mutual, which is about credit risk. So, why it became credit risk is because Washington Mutual using the subprime mortgage lending, which is very high risk due to the loan given to the borrower with a low credit score. So, after applying this strategy, the bank approved many high-risk loans without properly considering borrowers' ability to pay. So, the higher interest rate, the higher the debt, makes people don't get the chance to repay back. So, Washington Mutual suffer losses that makes credit risk became one of the factors for their failure. So, for the second risk, which is operational risk, that became due to Kerry Killinger, which is their ex-CEO. So, Kerry Killinger focused on growth and market share expansion, and he also failed to implement effective internal controls and prevent mortgage fraud. how the fraud became. How the fraud came to Washington Mutual? It is because even though the application have an income that suspicious, they still approve it. So the bank prioritize quantity over basic standards and regulation of the loans. In conclusion, Washington Mutual became a fail because their credit risk and operational risk.
Okay, next. For the Washington Mutual, I actually made a cool slide for you guys. So it's gonna be like this. So this is Washington Mutual where we next slide you can play some games and this is me and also Syakir actually in our and next Washington history. I will talk about the historical data of Washington Mutual. Okay, so based on what way, sorry, I left my face. Okay, so based on this historical data that we have found, we can see that we have total asset and also the net income and also the non-performative loans and also the share price, and from 2006 until 2008. So basically, if you want to understand how the biggest bank failure in the US happened, so this table shows you everything, the exact numbers of it. So this is the story of the how Washington Mutual went under, and on their downfall. So let's start with their total asset. So the overall value of what the bank owned in 2006, we can see that they were worth $352 billion. By 2008, that dropped to $307 billion, losing $45 billion in just 2 years. Was a massive warning sign that the housing market crash was hitting them really hard. But they don't really see it. They don't really see it. But the real shock, guys, is their net profit. In 2006, the bank was doing really great, but they made around $3.6 billion in profit. Just 1 year later, all the money vanished, and they actually lost 6-7 million. By 2008, things got way worse, and they lost a giant amount of $6.1 billion because people stopped paying their mortgages. Yeah, guys. So that brings us to the main problem, bad loans. So look at how fast the percentage of unpaid loans shot up. It went from a totally normal 0.9% to a dangerous 7%, from low to really high. This happened because the bank had been way too aggressive, giving out risky loans to people who couldn't afford them. Suddenly, a huge number of borrowers they couldn't pay the bank back. So basically, they lost so many money from so many people. So when everyday investors saw this, they panicked and sold all their stocks. The share price tells the final story. It crashed from $45 a share down to less than $1 single dollar. At the end of the day. So in the end, guys, these numbers prove that the bank's collapse wasn't an accident. Actually, it was the direct result of taking way too many big risks that finally caught up with everyone. So it's a really bad management back then. So that's why Washington Mutuals had a really bad luck on this. So that's all from Washington Mutuals.
That's why they fail now. And now I want to hear some recommendation and comparison.
Alright, now that we've discussed the recent performance faced by both companies, let's compare them and see why they experienced very different outcomes during the financial crisis. But before that, if we look at the Bank of America SWOT analysis, we can see that the bank had several strengths, especially its diversified business model and strong market position. These strengths played an important role in helping the bank remain resilient during the crisis, even though it's also faced weakness, such as high exposure to mortgage-related assets and risky acquisitions. So, why did Bank of America survive while Washington Mutuals failed? I think there are three main reasons that I've concluded. First, that Bank of America had a more diversified business model. while Washington Mutual rely heavily on mortgage lending. Second, Bank of America improved its risk management and governance practices after the crisis. Lastly, the bank was able to maintain its financial stability and access to funding, whereas Washington Mutual faced several liquidity problems that eventually led them to collapse. So overall, that I can conclude that these two cases shows that good risk management, diversification and strong governance are crucial for banks to survive during periods of economic uncertainty.
So moving on to our comparison, let's take a closer look at Washington Mutual through a SWOT analysis. Strictly, Walmart's greatest strength was its massive trusted retail banking footprint and strong customer loyalty built over a century. However, this strength hid a fatal weakness and extreme concentration risk. They missed big opportunities to diversify into wealth management or commercial banking, leaving them entirely exposed to their greatest threat in the 2008 US housing collapse. So for section 4.2, risk identification, mitigation and outcome. So when we compare how both banks handle risk, the execution gap is stark. Walmart fundamentally failed to identify the structural dangers of its own aggressive lending strategy. They pump out high-risk subprime loans and auction arms without properly checking if borrowers could actually pay them back. To make matters worse, their risk mitigation was completely ineffective. So the final outcome, a total collapse of investor and depositor confidence, massive bank runs and regulators stepping in to close the bank and sell its remains to JP Morgan Chase.
A few moments later.
Okay, so for the section 4.5, recommendations for future risk management. So what can future financial institutions learn from this disaster to make sure it never happens again? We have 3 core recommendations. First, ditch the all-in-one basket approach. Bank must mandate strict limits on single asset exposure and build a balanced mix of interest and fee-based revenue. Second, never let FOMO dictate lending standards. Finally, give risk teams a real voice and a seat at the table. The Chief Risk Officer must report directly to the board, entirely isolated from sales and revenue pressures. Corporate governance must actively empower risk managers to sound the alarm before vulnerability turns terminal. That's all from me. Thank you.
Good explanation, guys. Well done. So before we dismiss, submit the report by tonight.